Hi everyone, I'm back again. Today I'll be covering market cycles. What are they? Why understand them? And how to understand them. What are they? So, market cycles are phases that the market transitions into and out of over time. There are four phases that the market can transition into. Stage 1 ambivalence, Stage 2 greed, Stage 3 indecision, and Stage 4 fear. So the market will always be in one of these four stages, and the length and intensity can vary. So here you can see Stage 1. These are scribbles because I want to illustrate that the market has imperfections, so these are generally what the trends look like. Now, Stage 1 ambivalence. Buyers and sellers, you could see, are relatively ambivalent to whether they want to push the price of the market up or down. Buyers would push it up, sellers push it down. Stage 2 is marked by higher highs and higher lows, indicating a Stage 2 upward trend. This is where buyers are taking over sellers and pushing the market higher. Stage 3, there's plenty of market activity of buyers and sellers, but they're in sort of a tug of war, pulling back and forth without any real trend direction. Stage 4 is marked by lower highs and lower lows, where sellers are ultimately pushing the market down. So now that we understand the phases of the market, I want to talk about market cycle social effects. So here we have many social classes or types, and this chart is the 90s tech bubble on the S&P 500. So we can see here on the bottom left we have a Congress type. This type is the first to get into the market. They're the earliest to get into the market, and they have inside information that nobody else does. So as you can see, these are like the Mitch McConnell or Nancy Pelosi types. Then you might have institutional traders who get in next. These are the early movers. They are the Goldman Sachs, Morgan Stanley, JP Morgan, etc., who are the real market makers and who have large volume that moves the market. Then after them, you might have retail traders who follow trends. They've identified a trend. In this case, we can see a Stage 2 upward trend with higher highs and higher lows. So now they would enter the market. After them, you would have, depending on where you work, you might have a stock tip from Water Cooler Chit Chat. That would be the next type to maybe get in somewhere up here. And then you have the news. This is mass awareness on a large scale where markets are breaking all-time highs and it's hit mainstream media. After that, you might have a grandparents type. This is the peak hype. So these might be the last people to get in after hearing from the news all-time market highs, right? So as you can see, there are various social classes or types that affect the market movement. So now I want to show the best case and worst case and somewhere in the middle. So as you can see, best case would be if you're fortunate enough to be in Congress or associated with that in some way. They're going to be the best off buying at the low, selling at near the high. Then with the right education as a retail trader, you might buy just above that and sell maybe once you've identified a stage 4 downward trend here. And worst case, the people like the grandparents type who might have been the last people to get in after news, they buy, and perhaps they might sell when they're down 20, 30, 40% for whatever reason. Maybe they need cash or some other reason, maybe just because of the losses are adding up. So yeah, this shows that if you can avoid being the grandparents type, most likely won't be the Congress type, then you can do pretty well being the retail trader type. So why understand it? So that you can form a total market bias when trading. Whether you are investing long term or trading short term, you can ensure that you will have better than average information to base your decisions off of. So successful retail traders can read trends and obtain knowledge that average people don't have, such as coworkers, news, grandparents types. So also when a particular phase is present, you can remain in emotional control because your expectation meets reality. So you won't give in to emotional impulses that might lead to bad decisions. This will allow you to take advantage of opportunity in the market when it presents itself. So how to understand it? You want to learn the foundations of chart reading. That will be a good start. Read Technical Analysis of Stock Trends by John McGee. He laid the groundwork for technical analysis and chart reading. Highly reputable person, graduated from MIT. Definitely recommend reading that. Then you can watch the first part of my Udemy course to grasp the basics. Understand the social effects that take place in market cycles. This is what we covered today. And ignore coworkers, news, grandparents, etc. types, and instead form an objective analysis based on a solid foundation of education. Thanks for watching. If you're interested in learning more, you can click on the following video to watch the first part of my Udemy course. Please subscribe if you haven't already, and that's it for now.